Quick question. When you make money investing through an app, who tells HMRC? Because when you earn interest on your savings, your bank reports it automatically. But make money investing, dividends, profits, and for most ordinary accounts, don't assume HMRC gets a feed, and don't assume the app has sorted the tax. Where tax is due on investing outside of an ISA, it's normally on you to tell HMRC, and that catches app investors out all the time. The good news. For most people, the fix is one tick box, chosen at sign up. Get it right and there's nothing from that ISA to declare on your tax return. Get it wrong and you could owe tax you've never heard of with a deadline attached. So let's look at the tick box, the two tiny allowances, the trick that undoes itself, and crypto's new era, all under the microscope. Here's the tick box. When you opened your investing account, you chose, maybe without even noticing, between a stocks and shares ISA and a general investment account, also known as a GIA. Same app, same funds, completely different tax life. Two investors, 20 grand each, same funds, same year. Each collects £800 in dividends and each sells some winners, £4,000 of profits. Investor 1 is inside the ISA, tax on the dividends 0, on the gains 0, amount to declare on their tax return nothing. The ISA is a sealed box. Up to £20,000 a year goes in and the taxman stays outside. Investor 2 ticked the GIA. Say their personal allowance is already used by their salary. No losses, both allowances free. Then £300 of those dividends is taxable. £1,000 of that gain is taxable, and here's the kicker. It's on them to work that out and to tell HMRC. Same behaviour, same app, one tick box apart. So, what are the numbers? Two allowances, both small. Dividends, the first £500 a year, tax-free. Above that, for 2026-2027, it's 10.75% at basic rate, 35.75% at higher. And yes, those rates went up in April 2026. Gains for the 26-27, there's a £3,000 annual exemption for net gains you realise when you sell or otherwise dispose of investments. Above that, on shares, 18% inside your basic rate band and 24% above it. And the reporting, if you already file self-assessment, your dividends go on the return. If you don't and tax is due, dividends of $10,000 or less can normally be dealt with by telling HMRC. They may collect it through your tax code. Over $10,000 in dividends, that's self-assessment. Gains can go through self-assessment too on HMRC's real-time capital gains service. And if you owe tax and you've never filed before, tell HMRC by the 5th of October after the tax year ends. Miss it and the interest and penalties can apply. Now, maybe you're already planning something clever. Sell, bank the tax-free £3 grand, buy it straight back. About that. Just a quick one, guys. If nobody's ever explained this stuff to you, that's exactly why this channel exists. Please give this video a thumbs up, hit the subscribe button, and get notified when we release our next video. Let's get back to it. The trick sounds perfect. Sell your fund, use the £3,000 exemption, rebuy a few days later, reset the clock, pay nothing. Except HMRC got there decades ago. Rebuy the same asset within 30 days and your sale isn't matched against what you originally paid. It's matched against the rebuy. Buy back at about the same price and the gain you tried to bank can vanish completely. The trick undoes itself. And when you do sell for real, your cost normally isn't those shares I bought in 2021. It comes from the pooled average cost of what's still in your holding. HMRC calls it the Section 104 pool. Most app investors have no idea what their pooled average is, so keep your statements. The version that works is called Bed and ISA. Sell in the GIA, a normal disposal, using any exemptions you've still got, then rebuy the same fund inside your ISA. Nothing's dodged, the future growth is simply sheltered. One more quiet trap, accumulation funds. No cash ever lands in your account, but tax can still be due. Check the platform's annual tax statement and keep your own records. And then there's crypto. For years, plenty of people assumed it was invisible to the taxman. In 2026, the reporting rules changed significantly. Under new international rules, in-scope crypto platforms are collecting their users' details and transactions right now. and their first reports covering 2026 land with HMRC in 2027. The reporting gap is closing. The tax rules broadly follow shares. Same pooling, same 30-day rule, but watch this. Swapping one coin for another counts as selling. Spending crypto counts as selling. Even gifting it usually counts, unless it's to a spouse, civil partner, or a qualifying charity. And some rewards like staking can be taxed as income instead. If you've been trading for years and never told HMRC anything, the time to sort that is before the reports arrive, not after. Recap under the microscope. The wrapper decides the tax treatment, so check whether an ISA suits you before using a taxable account. Outside the wrapper, £500 of dividends, $3,000 of gains, then it's your job to speak up. The sell-and-rebuy trick undoes itself. Bed and ISA is the clean version, and crypto's first reports land in 2027. Got cash savings too? Our Save and Interest video covers the letter HMRC might send you, and if you're still scared of the 40% tax bracket, the myth bust is right there. Keep your money under the microscope. Thank you for watching, and see you on the next one, guys.